If you can value a small business quickly and credibly, you can make faster decisions, negotiate with confidence, and avoid expensive mistakes. In this session, we'll use a practical 3-step framework to estimate value in minutes, then refine it with simple checks. First, separate enterprise value from equity value. Enterprise value is the worth of the operations before considering cash and interest-bearing debt. Equity value is enterprise value plus excess cash minus debt. Also set context. Most small business transactions are asset deals, where the buyer purchases operating assets and the seller pays off debt. We'll work with normalized earnings, not raw tax returns, and we'll translate messy books into a clean, defensible range. The goal, a clear number you can explain on a whiteboard, backed by assumptions you can defend. Here's the roadmap. Step 1. Normalize the numbers. Gather the last 3 years of financials plus trailing 12 months. Recast to reflect true, sustainable earnings. Add back owner perks, remove one-time items, and set expenses to market. Step 2. Apply valuation approaches. Use market multiples for speed, cross-check with an income approach, capitalization, or DCF, and consider an asset approach when appropriate. Step 3. Reconcile and sanity check. Triangulate a range, bridge to equity value for deal structure, and stress test affordability with debt service coverage. Define the standard of value as fair market value for a going concern, under a control premise, typical in small business sales. This clarity prevents apples to oranges comparisons and keeps the process disciplined and fast. Start with inputs you can trust. Collect 3 years of P&L and balance sheets, year-to-date and TTM, tax returns, payroll reports, bank statements for spot checks, sales tax filings, and a fixed asset list. Convert cash basis books to accrual where feasible. Match revenues with the period services were delivered, adjust inventory changes into cost of goods sold, and align prepaid and accrued expenses. Note revenue mix by product, channel, and customer segment. This informs risk later. Create a simple TTM schedule so you're not anchored on a stale year. Flag outliers, like a one-time PPP grant or a large legal settlement. Your goal in this step: build clean, comparable, periodized financials that represent normal operations, not unusual spikes or dips. Recasting begins with owner impact. For very small businesses, compute SDE, seller's discretionary earnings, pre-tax profit plus owner salary, payroll taxes on that salary, interest, depreciation, amortization, and personal perks run through the business. For larger, use EBITDA and treat owner as a manager at market pay. Adjust rent to market if there's a related party lease. Remove one-time items, lawsuit proceeds, disaster relief, a short-term project unlikely to repeat, or a temporary COVID bump. Also add back clearly non-operating expenses like personal vehicles, family on payroll not working, and club dues. Conversely, remove under-recorded costs, like if maintenance was deferred or if a key employee was underpaid. The objective is sustainable, transferable earnings a buyer can rely on. 2 companies with identical earnings can deserve very different multiples based on quality. Map revenue sources into recurring, contract subscriptions, reoccurring, repeat but not contractual, and one-off project work. Note customer concentration. List top 5 customers and their percentage of sales. Over 20-30% in one account increases risk. Check churn and retention for recurring streams. Plot seasonality on a simple monthly line. Deep troughs stress cash. Evaluate backlog and pipeline to gauge near-term visibility. On working capital, compute net working capital, AR plus inventory plus WIP plus prepaids negative AT, accruals, and its typical level as a percentage of sales. This informs what the buyer expects to receive at closing. Also distinguish maintenance CapEx from growth CapEx for cash flow realism. Choose the right base. For owner-operator businesses, SDE reflects total cash flow available to one full-time owner before debt service. For firms requiring professional management or with multiple managers, use EBITDA and include a market manager salary in expenses. Build a TTM schedule to smooth seasonality. Example: revenue $2.0 million, COGS $1.2 million, gross profit $0.8 million. Operating expenses $0.5 million, including owner salary $120K, depreciation $30K, and some personal auto $10K. Operating profit $0.3 million. Normalized to SDE $300K, plus 120K owner plus 30K DNA plus 10K perk equals 460K SDE minus 10K one-time legal equals 450K. If buyer will hire a manager at 90K, EBITDA proxy approximately 450K minus 90K equals 360K. These will drive multiples in income models. Market multiples deliver speed. For very small owner-led businesses, use SDE multiples. Typical ranges are roughly 2.0x to 4.0x SDE, depending on size, growth, and risk. For larger firms with professional management, EBITDA multiples often span approximately 3x to 6x, sometimes higher for niche or recurring revenue models. Calibrate with deal databases, e.g. biz-buy-sell insights, peer comps, industry brokers, and adjust for your specific risk factors. Customer concentration, cyclicality, key person dependence, and documentation quality. Size matters. Bigger, cleaner earnings tend to command higher multiples. Apply a base multiple, then tweak. Add for recurring revenue and strong growth. Subtract for concentration, seasonality, or outdated equipment. Quick math on our example. SDE 450K times 3.2x, mid-range with moderate risk, suggests about $1.44 million enterprise value before cash and debt. Cross-check the multiple with an income approach. Capitalization method. Value equals normalized cash flow divided by cap rate. Derive a cap rate by setting a required return for small business risk, then subtracting long-term growth. For example, required return 25% minus growth 3% yields a 22% cap rate. Using EBITDA-like cash flow of $360,000 less maintenance capex $50,000 gives $310,000. Value is approximately $310,000 divided by 0.22 or about $1.41 million. Alternatively, run a simple 5-year DCF. Start with $310,000, grow 3% annually, discount at 22 to 25%, and apply a terminal value using cap rate or exit multiple. Sensitivity matters. A 1 to 2% shift in growth or discount rate can move value meaningfully. This step validates or challenges the market multiple. The asset approach anchors value to the fair market value of net assets. It becomes primary when earnings are weak, volatile, or negative, when the business is asset-heavy, trucking, manufacturing with significant FF&E, or when the buyer wants a liquidation floor. Steps: adjust book values to market, appraise equipment, right-size inventory to saleable amounts, value WIP conservatively, and remove obsolete stock. Add non-operating or excess assets, extra vehicles, or excess cash. Subtract all interest-bearing debt and liabilities tied to those assets. Real estate is typically valued separately and leased back at market rent. For healthy going concerns, this method provides a floor, often below income market values, but it can define the deal in distressed or underperforming cases. Triangulate a range by weighing the methods that best fit the business. Example weights: market multiple 50%, income 40%, asset 10%. For a stable, service-based company, build an enterprise-to-equity bridge. Equity equals EV plus excess cash minus debt. For asset deals, think in terms of purchase price for assets plus a normal working capital peg delivered at closing. Then run affordability checks. Debt service coverage ratio, DSCR, should generally exceed 1.25 times under realistic financing. Estimate loan terms, e.g., SBA 10-year amortization, prevailing rate, compute annual debt service, and compare to post-acquisition cash flows after a market manager wage and maintenance capex. Cross-check with simple revenue multiples used in the industry and confirm the implied owner or manager compensation is competitive. Let's run the numbers using our example. We normalize to SDE 450K and EBITDA-like cash flow 360K with 50K maintenance capex, modest 3% growth, and moderate risk. Market approach: SDE times 3.2x equals EV 1.44 million. Income approach: 310K divided by 22%, approximately 1.41 million. Asset approach: adjusted net assets, appraises to 1.10 million. Weighting 50, 40, 10 gives 1.44 million times 0.5 plus 1.41 million times 0.4 plus 1.10 million times 0.1 equals 1.37 million enterprise value midpoint. Propose a range 1.30 million to 1.45 million. Assume an asset deal with normal working capital delivered. Seller retires debt. Financing check. Price 1.37 million, 10% down. SBA loan 1.233 million at 10.5% for 10 years. Annual debt service approximately 200 to 210K. Post-close cash flow approximately 310K, so DSCR 1.5x, acceptable. This confirms a defendable price band and deal structure. You can value nearly any small business in minutes by following this sequence. Normalize earnings, apply multiple and income methods, then reconcile and sanity check. Package your work with a one-page summary. Assumptions, normalized earnings build, chosen multiple and comps, income method inputs, cap rate growth, asset floor, EV to equity bridge, working capital peg, and DSCR test. Watch common pitfalls: underreporting cash sales, missing deferred maintenance, off-balance sheet liabilities, leases, warranties, owner dependence without a documented handoff, customer concentration without contracts, and inventory quality issues. Negotiation levers include seller financing, earnouts tied to retention, and escrow for working capital true-ups. When details change, new contract, lost customer, update the model fast. Your advantage is clarity, a number, the why behind it, and credible guardrails.